Many are wondering just exactly what's going to happen to the housing market if the United States enters recession. Would interest rates, prices, and payments go down? Would inventory, job loss, and foreclosure go up? And would things change enough for the average American to comfortably afford to purchase a home again? And another question is will I be able to purchase homes for pennies on the dollar? Now, we're going to look at many different factors today, such as home prices, foreclosures, and unemployment, and how historically recession impacts each of those things. Now, odds are we're going to enter recession and exit a recession with home prices and interest rates going down. However, if we enter a depression, then I believe home prices will go down by an unimaginable amount. The really important thing is that you guys position yourself to become winners through this extremely turbulent housing market and a recession. And some of the things that you guys should do is obviously maintain your purchasing power and study the markets and understand the math on where you want to purchase a home in. Always remember, you guys, that real estate is hyper local. And you guys don't forget to like this video, share the video, comment, and no matter what you do, I hope you guys enjoy. So what we're going to do is we're going to jump back and forth from this Newsweek article, depending on what segment it's in. And then I'm going to jump into the actual housing market data. And we're going to try to formulate an opinion based on the data and based on historical precedents on what's going to happen next in the housing market. Now, the name of this article is What a Recession Would Mean for the Housing Market in 2025. And honestly, guys, there are some pretty decent points here. As concerns about a potential recession in 2025 grow, many are questioning how such an economic downturn could impact the U.S. housing market. Now, they're saying why it matters. With inflation concerns and fluctuating interest rates, the economy is facing a pivotal moment. A potential 2025 recession could significantly impact the housing market, causing home prices and mortgage rates to drop. That's something I've been really honing in with you guys, basically letting you know, I know it's hard to have patience, it's hard to maintain our purchasing power, cut our expenses out, but if we do that, odds are we're going to be able to buy a house in a time when prices and interest rates are going down at the same time. Think about how cool that would be. Now, this scenario presents opportunities for buyers to enter the market at lower costs. However, it also raises concerns about financial stability, and I highlighted this for current homeowners and the broader economic implications. Now, remember, you guys, current homeowners right now, depending on when they purchased, have been bamboozled by either interest rate, prices, property taxes, or homeowners insurance. In fact, generally, the only homeowner that's pretty safe right now are people that purchased before 2020 that had realistic expectations of how property taxes, homeowners insurance, and HOA actually work. But let's continue. What would a recession do to the housing market? Historically, recessions have led to decreased demand, and I want you guys to think about that. We have almost a record historically low demand already before we even go into a recession. So losing even more demand and gaining supply from distressed sellers, think of the impact that's going to have on prices. But this continues. Historically, recessions have led to decreased demand in the housing market, resulting in slower home sales and in some cases declining home prices. During economic downturns, consumer confidence typically wanes, leading to reduced spending on significant investments like homes. Consequently, sellers may need to adjust their expectations, leading to more favorable conditions for buyers. Now, the chief economist at Realtor.com is saying, the housing market's response to recession varies widely, as seen in past downturns, and we'll take a look at some of those downturns here in a minute. She noted that the short-lived 2020 recession led to a rapid rebound in home sales and prices, while the prolonged 2007 to 2009 recession resulted in a slow recovery and significant price declines. She went on to state if a recession occurs now, home sales may not drop much further because they're already in the gutter. Remember that. But increased financial strain on homeowners could lead to rising inventory and softening prices. So what she's talking about there is job loss. If someone's a homeowner and also loses their job and they still have equity, more than likely they're going to list their house because they're now incentivized to sell their house, cash in, and rent for cheaper. Now we're going to move on to interest rates, and we'll talk about how recession impacts interest rates. How would mortgage rates be impacted? In response to a recession, the Federal Reserve often, almost every single time actually, implements monetary policies aimed at stimulating economic activity, such as lowering interest rates. That's why we keep pounding the table like, you guys are not going to lower interest rates unless they need to stimulate the economy. They're not going to stimulate the economy unless we go into recession and have out of control job loss. At least that's how it should work. These actions can lead to reduced mortgage rates, making borrowing more affordable for potential homeowners. Lowering mortgage rates can increase purchasing power, allowing buyers to afford higher priced homes or secure more favorable terms on their loans. Now, let me show you guys interest rates, and let's talk about what happens when we enter recession. Here's the 30-year fixed rate mortgages, and let's look at the last 4 recessions, and let's see what exactly happened to interest rates. So the last recession, which was basically lockdowns, interest rates went down through that recession. They started around 3.6 and dropped to about 3.3. So during recession, yeah, mortgage rates drop, but really what I want you guys to understand is interest rates drop significantly after recession as well, sometimes for several years, even a decade. So after recession, expect interest rates to continue to drop, as you guys can see here. Now, when we go back to the Great Financial Crisis, interest rates went from about 6.24 all the way down to 4.82. But for many years after the recession, you guys see interest rates continue to plummet after that recession. Now, when we go to the dot-com bubble, interest rates went from about 6.98 all the way to 6.56. And again, just like before, interest rates continue to plummet for over a year after the recession. Now, when we look at the 1990s recession, interest rates went from about 10.10, so 10%, to about 9.29. So it had a nice drop during the recession. But again, just like the last 3 recessions, interest rates plummeted for many years after the recession ended. So historically, when we enter recession, interest rates are going to go down, and for at least a couple years after. Now, the next question is the U.S. headed for a recession? As of early 2025, economic indicators present mixed signals regarding an impending recession. Certain sectors show signs of slowing growth, others remain robust. Factors such as global trade tensions, consumer debt levels, and geopolitical events contribute to economic uncertainty. Here's one really important set of data to look at to decide whether or not we're going into recession, which is GDP. Now, this is from the Federal Reserve Bank of Atlanta, and they are now forecasting the first quarter of 2025 to have negative 2.4% GDP. So we have data now that is saying, on top of all of the layoffs, that we're going to go to recession, and that recession is going to happen in 2025. So again, you guys, make sure you're positioning yourself well. And here's another factor that is telling us why we didn't go into recession yet. One is the Bank Term Funding Program, but also the national deficit. The national deficit is absolutely out of control. This is where we're at so far this year. We're upside down as a country for the first 3 months of this year, $839 billion. So that deficit is obviously keeping prices propped up, which is not good for America. Let's ask the question, is it cheaper to buy a house in a recession? Purchasing a home during a recession can offer advantages, primarily due to potential declines in home prices and lower mortgage rates. Buyers may find more negotiating power, reduced competition, and opportunities to purchase properties at discounted prices. That's what I've been preparing for. Hal told Newsweek that home prices and mortgage rates can decline during a recession, making it cheaper to buy a home, though this isn't always the case. She noted that past recessions, particularly in the mid-2000s, have shaped consumer expectations for better home buying conditions. So let's talk about home prices going down during a recession and why that might happen. Bottom line here is distressed sales. Normally, distressed sales don't happen until after the recession. And a distressed sales comes from things like people losing their job or potentially having a foreclosure or any number of other financial reasons or just life. So the first thing I want to point out is unemployment skyrockets after we go into recession. You guys can see that pretty much during every single recession. Here's January 2008, went from about 5% all the way up to about 10% in November of 2009. You guys see that in 2000 as well. Unemployment absolutely skyrockets. So again, when people lose their job and they have a home, if they still have equity, they're going to cash in on that equity because it now makes sense for them to sell. You guys see that in the 1990s as well. I mean, unemployment absolutely skyrockets, but not just unemployment, so do foreclosures. Foreclosures are not a recessionary indicator. Foreclosures happen after recession due primarily because of job loss. You can see that here with foreclosure starts. So here's 2006, 2007, and it really jumps up into 2008, 2009, 2010, 2011. I mean, multiple years after. And here's foreclosure sales. Same thing here. You can see it kind of went up in 2007, but really ballooned in 08. 09, 2010 was the maximum peak. And remember, we were out of recession in 2009. Yes, interest rates should go down, but when it comes to prices, prices of homes should also go down. Now, the last two recessions, home prices did go down somewhat. Here's the global financial crisis. Now, homes peaked around Q1 of 2007 at 322. They dropped during the recession to about 257, and that makes a nice little price cut for homes back during that time. But you guys will notice that it doesn't necessarily guarantee that we're going to have price cuts, but the fact that the PE ratios and the national payment to income ratio is so high right now, odds are that when we do go into recession and we have the unemployment and we have the foreclosures and we have the inventory from distressed sellers, prices will go down. The next thing here, guys, is what is the average price of a house in the US? According to data from Redfin, the median sales price of a home in the United States is $418,284 as of January 2025, reflecting a 4% increase compared to the same time period last year. This upward trend in home prices is influenced by factors such as limited housing inventory and sustained demand from buyers. Sustained demand, that's interesting. While home prices have risen nationally, the rate of increases has moderated compared to the double-digit growth observed during the pandemic years. Now, here's the thing, you guys, when it comes to prices, there's so much methodology used. These companies, none of these companies has the same median sales price because they're manipulating the math with the methodology. So if you really want to know what's going on, you have to access this right here. This is your multiple listing service, and you have to run subdivision analysis based on a property subdivision. And an analysis is going to look at this subdivision. So you put a subdivision in here, you check sold property, and an analysis is going to look at all the sold properties given over a period of time specific to that property subdivision. Remember, each subdivision is generally different. Now, not every property has a subdivision, but most of them do. If a property does not have a subdivision, what you do is you look at comps that are relatively close to the subject property. Make sure to do your subdivision analysis. I made a free form for you. Now, which state has the lowest home prices? As of December 2024, West Virginia actually had the lowest median home price in the United States at a whopping $249,000, according to Realtor.com. Other states with relatively low median home prices include Ohio and Michigan, with the median list price at $252 and $268. And the problem with that is that's where the investors go. So one of the things that I think that needs to change is we need to figure out a way to get Airbnb investors, institutional investors out of the housing market. Now, top 10 states with the lowest mortgage payments: number 1, West Virginia, Ohio, Michigan, and then number 4, somehow Louisiana, 5, Iowa, 6, Indiana, 7, Kansas, Mississippi, Oklahoma, and Missouri. But here's what I want you guys to understand when it comes to payments. This right here is one of the most important things, which is your amortization schedule. It's really important to understand that if you guys don't pay this off, you're going to be trapped in mortgage debt for the rest of your life. Literally, mortgage means a death contract. One of the best things that we can do as American citizens is make sure we pay our house off. Because you see here, you guys, if I borrow $324,000 at a 6.5% interest rate over 30 years, I'm paying back $737,000. However, if I make an extra mortgage payment of, say, $300 per month, let me show you how much I'm saving. I turn this loan from a 30-year loan to a 21-year loan, and I've saved in interest, you guys, sit down for this, $139,081 saved in interest. Let's talk about what happens next. Now, recent tariffs and economic policy shifts, including President Trump's remarks on a potential recession, have highlighted concerns about economic instability. Investors are watching stock market fluctuations and consumer confidence levels closely. as trade tensions and policy uncertainty could impact business investments and hiring trends. Let's not forget we've been in a period of quantitative tightening for about 3 years. So it's just finally everything is now starting to catch up. Hopefully things will continue. This is what I want to say if you don't own a home yet. Remember, I've made a free home buying class for you. Take that class. The main things that we got to do if we're on the sideline waiting to find a deal of our dreams is we got to work on our credit, our income, and our assets. Now, after that, we have to work on our comprehension of our current market trends by analyzing the comparable data. All stuff I have for you at the Real Estate Mindset Empowerment Center. Now, I'm going to keep this video short. Let me know if you guys like this video. Nice little short housing market video with some tips. Comment below. Let me know what you think. And other than that, if you guys are out there investing in real estate, you guys already know I wish you luck, and I hope you win.